Welcome guys to Purvis Opinion. And on this video, I want to talk about something very near and dear to my heart, which is the dividends. And I think when people think about dividends, they don't completely understand just how valuable a concept and how critical a concept dividend is when it comes to investing in the stock market. Because people think about the stock market, oh, you buy low, you sell high, or you short. People, or you do day trading and all that scalping and all that, but people don't focus on dividend, okay? Because dividend-based investing in stock market has made many people rich. It's a long-term game, no doubt, but it's a game that most people, young people, should understand at a young age because it's a game they can get into early on and just stay in it for the long run. So, yeah, like I want to go through, if you guys don't know who Benjamin Graham is, he's basically for a very famous economist in USA, and Warren Buffett is a big fan of him. So I'll go through 10 quotes that Benjamin Graham said about dividends in stock market. And so I think that'll give you guys a good understanding of what dividend actually means in stock market, right? So let's get started. So again, obviously you guys can go and search and find out these codes yourself, no doubt. But I want to just add a bit of my own flavor to what I think Benjamin Graham is trying to say in these codes. So let's start with number one, 20-year dividend record as a quality test. So dividend record, one of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. Okay, so the explanation is Graham is saying that a long unbroken dividend history is a practical proof of quality and resilience. A firm that has kept paying dividends for 20 plus years has usually survived recession, crisis, and industry shocks while still rewarding shareholders. So for conservative defensive investors, simply screening for this track record already eliminates a lot of weak or speculative companies. Now, here I'll add two caveats. So I'll add two caveats here. One is that obviously past record is not an indicator of future trend. Okay, that's number one. And a lot of big companies in S&P 500 don't give out dividends anymore. Okay, a lot of tech companies has stopped giving out dividends. They just do share buybacks. So dividend used to be a big deal in the USA in the 90s, in the 80s, but it's not so much anymore because companies are more focused on short-term share buybacks that, attract new investors rather than focusing on retaining old investors, right? So the market, especially in the developed world, it has shifted from where the companies would focus on retaining their old investors. But now they're just focused on getting new investors. They're not focused on retaining their old investors. So that's where share buybacks come in. Okay, the second caveat here is yes, 20 years is a good track record to use as a quality test, sure, but not, I mean, that only works for developed stock markets. Like if you go to emerging markets or frontier stock markets, like for example, let's say Bangladesh, like Bangladesh stock market as it stands right now has come into fruition around the 92. So it's kind of like around 30 years old. So an exchange that's around 30 years old and you're applying a 20 plus years old dividend rule, it just doesn't add up, right? So again, it's a good rule. It's a good rule for, I believe, emerging markets that are 50, 100 years old. But it's not a good rule anymore for developed stock markets because, like I said, they're more focused on short-term gains now. And also, it's not good for frontier stock markets because, they're just not there yet to use a 20 years quality test. So high dividend return plus reinvested earnings. Okay. First, the dividend return is relatively high. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In a 5 to 7 year period, these advantages can bulk quite large in a well-selected list. Third, a bull market is ordinarily most generous to low-priced issues. Thus, it tends to raise the typical bargain issue to at least a reasonable level. So here Graham is highlighting a double engine. You can earn cash dividends today, yeah, and you also get the benefit of retained earnings being reinvested inside the business. Over 5 to 7 years, a cheap stock with a good dividend and strong reinvestment can compound strongly. In bull markets, such undervalued, lower priced stocks also tend to get re-rated upwards, giving a kicker to total return. Now, this is very interesting because this is a concept that I think a lot of investors nowadays they overlook, which is what happens when a bull market starts, right? And this is kind of common in most stock markets around the world. When a bull market starts, you have money flowing in to shares with solid fundamentals, shares with not so solid fundamentals, and a lot of, small market cap, where gamblers get in. But smart money, again, I'm gonna separate here between dumb money and smart money. Smart money is what I call institutional money, right? The big money. Smart money flows into undervalued, low price stocks with solid fundamentals. That's where the undervalue comes in, right? In a bull market, right? Because the idea, again, like I said, in a bull market, these undervalued companies do very well. Okay, they reinvest their earnings. They don't have to waste money in share buybacks because the bull market takes care of it. So I think, like, long story short, if you get into companies that give out continuous dividends and that dividend is reinvested into that company, whatever dividend is not given to shareholder, that one, then you are left with a scenario where you're getting regular cash flow from the company plus you're getting a reinvestment compound. So it is a good way it's a safer way to make money in the bull markets, right? You identify companies, strong earnings, strong reinvestment, strong dividends, and boom, and if they're undervalued or, not so overvalued and they're low priced, then you can expect smart money to get into those stocks, right? So that's basically what they're telling here. And so real money comes from holding and collecting dividends. All the real money in an investment will have to be made, as most of it has been in the past, not out of buying and selling, but out of owning and holding securities, receiving interest and dividends therein, and benefiting from their long-term increases in value. So Graham contrasts trading with investing here, right? He argues that sustainable wealth usually comes from owning good businesses for long periods, collecting dividends and interest, and letting intrinsic value grow, not from frequent trading, right? Just from the improvement of the fundamentals. And the dividends are central to the long-term compounding machine because they provide a steady cash return while you wait for value to unfold. Now, this is something I think most investors, retail investors don't understand, which is that if you own shares in a company that's regularly giving you dividends, that's giving you a regular cash flow, then your incentive to sell that share decreases significantly. if you're expecting the company to continue growing, if that makes sense, right? Uh, and if you're thinking like that, trust me, everyone else is thinking like that too. Nobody wants to sell their shares that are giving them regular cash flows. That's common sense, right? So now the question becomes, real money comes from holding and collecting dividends. True. To some extent, that's true. But again, this is the long-term game, right? And there are very few companies with solid fundamentals, solid dividend, releases, continuous, consistent, solid dividend releases that you can buy and hold for the long run. But again, this is where it comes down to, like, whether you need the money today, tomorrow, 10 years from now, or how greedy you are. So again, this is a value investing. This is literally what we call value investing. And this is not trading by any measure of the game. So yeah, like if you want to do value investing, this is it. But I will say this. If there are a lot of significant companies that have been giving out dividends for decades that went out of operations, that went bankrupt. Okay. So, and the share appreciation is only valid as long as the company keeps announcing new dividend releases. The moment the company decides to cut down the dividend future outlook, then you're going to see significant share depreciation because all those people that are holding those shares are now gonna dump at the same time. So the problem here is companies that give out consistent dividend, where the shareholders are willing to hold the shares for future cash flow. The problem here is the company's share price is significantly sensitive to its dividend news. And that's an issue. That could be an issue in a bad time. So, yeah, I do understand where this uh, idea comes from, but again, it could be an issue in bad times. That's what I'm saying. So, when stocks yield as much as bonds, you get the growth free. So, if a stock's dividend yield is similar to the interest you earn on a bond, you're already matching the bond's current income. Okay. But unlike a bond, a solid business can grow earnings and dividends over time. In that situation, the future growth of dividends and price appreciation is like a free bonus on top of bond-like income. Again, this is pretty obvious and straightforward, so I'm not going to explain. So trade-off between income and appreciation. The stockholder wants both income and appreciation, but in general, the more he gets of one, the less he realizes of the other. So this is again, we come back to that. If you're getting a constant cash flow, you're not going to willing to sell those shares. So the more you get of dividends, the less you want to sell your shares. So the less you want to take the profit, right? And vice versa, right? If you don't get a lot of dividends, you're willing to sell the shares. So Graham is pointing out a common trade-off. Very high payouts can limit how much the company reinvests in growth, potentially lowering capital gains. Conversely, firms that retain a lot of earnings for expansion may pay smaller dividends now, hoping for higher future prices. Smart investors balance current cash needs against long-term growth potential instead of blindly chasing maximum yield. Right? So it's a balance. You can't get the best of both worlds here, but you're trying to get you need to have your own threshold of what my cash flow I'd be happy with from this share and versus how much I see the long-term growth in this share and when I'm willing to exit from this company, right? So you need to have a plan. That's the thing. When you invest in a company with this dividend playbook, you need to have a plan, exit strategy is what we call it, right? So value equals to price versus earnings, dividends, prospects, assets. The true measure of common stock values, of course, is not found by reference to price movements alone, but by price in relation to earnings, dividends, future prospects, and to a small extent, asset values. Here, Graham warns against looking at only price charts. He says valuation must be anchored in fundamentals: how much you pay relative to earnings, the dividend you receive, the company's future outlook, and its asset base. Dividends are one key variable among several, but price action by itself tells you almost nothing about true value. True. The value is when you compare the share price to the earnings, dividends, and other prospects. Don't buy just for income. It's an axiom of investment that security should be purchased because the buyer believes in their soundness and not because he needs a certain income. Graham warns against yield chasing. If you buy a stock only because you need a high dividend, you may ignore the company's financial strength and overpay for risk. The right approach is to first ensure the business is sound and the security is reasonably valued. Then consider whether the dividend fits your income needs, right? In good times, investors ignore the numbers, right? They see dividends going up, stock prices rising, they stop paying attention to balance sheets. And yeah, you should stay disciplined and focus on the underlying numbers. So long dividends history and no recent deficits. The company should have a long record of paying dividends and no deficit in earnings in the last 5 years, right? Consistent earnings are more important than growth earnings, right? Growing earnings. Now this is the key because company that's earnings are consistent versus that's much more important than a company's earnings if the earnings are growing or not because you're looking for stability, right? And it's a demonstration of willingness to share profits via dividends, right? A firm that has avoided losses and kept paying dividends shows reliability. He even prefers steady, predictable earnings over flashy but volatile growth because stability better protects the investor's capital and dividend stream. So dividends are a positive signal. This is the final one. An uninterrupted record of paying dividends for at least 20 years is a positive quality factor. Dividends signal management confidence in future earnings. Here, Graham adds the signaling angle. Management would hesitate to commit to a regular dividend if they weren't reasonably confident about future profits. Make sense? So maintaining a long dividend record suggests both financial strength and a shareholder-friendly policy. So for an investor, this history can be used as a practical screening tool to find higher quality companies. Again, this is all very intuitive, so I'm not going to get into it, but I thought this was something that people needs to understand because nowadays people want to get into investing, trading, they don't understand the fundamentals or they don't try to understand the fundamentals. And so yeah, I thought this was an important topic that I'll bring up. Yeah, that's it for this one. I'll come back with another one pretty soon. Until then, peace guys.